So what do we look for? We will look for the rental yield. So rental yield is the annual rent divided by the property value multiplied by 100. So if we need to calculate a rental yield, let's say we buy a property for $500,000 and we're receiving $500 a week, then the rental yield is equal to 500 times 52 weeks divided by 500,000. And that's a 5.2% rental yield. So anything with a minimum of 4% rental yield is acceptable. And then the vacancy rate. Vacancy rate really is the number of vacancy properties divided by the properties that are for rental in an area. So again, you want to make sure that you're looking at getting into a property with a very low vacancy rate. And here we're talking about probably a minimum of about 2% as a maximum acceptable vacancy rate. And then the annual growth rate, as well as owner-occupier percentage and days in the market. Look, if we want to average out anything in the major capital cities, around 6 to 7% on average, let's say over more than 10 years is acceptable. And probably in regional areas, anything around 5 to 6% is also acceptable as well. This growth could be slightly lower if we're buying apartments, because apartments tend to grow slightly lower than houses. And then owner-occupier percentage, we touched it earlier on, where you're looking at in a city or in a suburb, on the total number of houses, how many are owner-occupiers compared to how many are renters. So you want to make sure that you're buying in an area where there are more owner-occupiers than there are renters. Simply, like what we mentioned earlier on, you want to make sure that one, there's owner-occupier appeal, and most importantly, there's also less competition when your property comes onto the market as well. And then days on the market. Days on the market, one day you might want to sell your property. So the less the days on the market, it means that if you put it on the market, then buyers are going to snap it. So there's a higher demand in that area compared to an area where the days on the market are longer. So if a suburb has got strong rental yields, low vacancy, and higher owner-occupier appeal, you are looking at consistent capital growth. And the underlying word here is consistent, because that's what you're looking for.